Coreweave stock is taking a massive hit over the past few weeks, including Nebius stock. We're going to be going over Coreweave specifically and then diving in the comparisons with Nebius as well. I'll be going over both of these companies, breaking down the charts, overall outlook, and ultimately which one I think is more bullish, which one I would be buying on the dip for myself personally, and everything in between. If you have any questions, comment down below and let me know your thoughts. Let's get into it. Now, a few overall thoughts is what I want to show you. Quick, we look at Coreweave as a chart. We look at the stock price here, go to the daily chart. It's pretty nasty. We can all agree this is a nasty looking chart. You are getting tore up. You're on the decline. You're making lower highs. You're breaking down and lower lows, and you're pushing IPO lows now. At this point, you're $65 right now. Going into something like Nebius, showing you that chart as well. We'll go more into this also. Nebius, in my opinion, looks a lot cleaner. Been around a little bit longer. Not that recent IPO, but again, very interesting to be talking about, looking at as well. And since the last video we went over Nebius, I'll show you guys that one as well. Target has been $70, and it looks like we're closing in on that. So again, what we're looking at now. We're also going to be breaking down, as you can see here, we've gone over Nebius already. We'll go over Coreweave and then go over the similarities and which one's a better play overall. But what I want to say, off rip here, guys, is, a lot of people get concerned, like, well, what's going on with Coreweave? Is it a scam? Is it this? Is it that? And that's not really the way I would think about it. It's, yeah, you should be worried if a company is scamming or, is it, a bad company to buy? You need to be doing your research. But you should get more excited when you see these aggressive dips, because that's where you really want to buy equities and you want to buy stocks. That's what you want to do. You want them to dip because that's what's going to give you the opportunity. If I had a nickel for every time someone freaked out about a dip, I'd be like, oh, here we go again, boys, right? Go look at something like, let's look at AMD. Let's use AMD as an example to get rid of all the drawings so you can see over the past, few years. AMD's had some pretty big declines. 2021, you dipped down in 2022, down to $60. You climbed back to 220, you dipped back down to 78, you climbed back up. This is a great example of dips were great opportunities if you like the company. Let's go to NVIDIA, the number one company in the world right now, right? You've had some dips here as well. You went to 150. This year you dipped down below $100, which was, a godsend. And that was a great opportunity. You go back here, into 2022. No one even talks about this, but you went from essentially $33 down to $12, and you went crazy back to the upside. So dips are opportunities on good companies, okay? So I think it's a very important thing to understand before we jump to conclusions. And when you get this is the time that I think people have to be, if you like Coreweave, this is the time that you have to look to buy it, right? So it's very important. I know it's very elementary, and some of these people here, you want to get rich quick. I will say right now, I don't think my content's for you if you want to get rich quick. I just don't think that's the point of this channel. But again, let's break down Coreweave. Let's break down, go do the work. Let's get to work here. Now, before we go too far, I do want to say right now, number one, I would appreciate if you hit the subscribe button. It helps out a lot. A lot of the people that are watching the videos are not subscribed, believe it or not. Also, too, the Twitter link is down below as well for all the charts, all the additional plays, everything that I push out there. So to let you know that, it's like today I made two big posts already, one for Oracle, one for Palantir. It's all free for you on Twitter and on TikTok as well, which is I actually live stream every time I make a YouTube video. So like right now I'm live on TikTok. So if you want to get access and ask more questions, get more insight, that might be for you. It's free of charge. Now, if you actually want to get more daily insight, what I'm trading, how I'm trading, everything in between and nonstop throughout the day, obviously I can't be on YouTube all day long, but Discord might be for you. The link for that is down below. Every day I start off with one thing first, and that's futures, understanding what's happening there. Because if you don't know where the market's going, then how can you really trade equities? Then you go into our scalps, which are all in technicals, all of our setups that we're looking for, everything in between there for you as well is all posted as always. And then obviously our profits, you can go see all that as well for yourself. Do what you got to do, but all that is there. And then obviously our swing trades are in trade ideas. We don't enter swing trades every day, so you're not going to get an exact trade or something like that every single day, but just letting you know that's all down below. Let's get back to work. Now, we're going to go to the chart second. I want to go more into the company first and break it down. So again, in the last video, and you guys, if you want, you can go to YouTube and go watch this for yourself. I'll cover this a little bit here in today's video, but I do recommend if you want to get the updates and kind of see like more insight on Nebius, this is a full breakdown, this video here about 3 days ago. But let's get into Coreweave. They're very similar companies, I will say that, but let's dive in. Now, Coreweave is a specialized AI cloud infrastructure provider built specifically for high performance compute and generative AI workloads. They are not a general cloud like AWS. They focus exclusively on their AI ML training, providing large clusters of NVIDIA GPUs, H100s, A100s, H200s, etc. These companies use and train large language models and foundation models. This is, again, where you're seeing that rental process. Again, similar model kind of to what's happening with Nebius as well. I mean, people, instead of buying these for themselves, building their own, data centers, etc., they'll just rent out and use someone else's and do the workload like that. So very important to understand that. High performance compute, workloads, VX rendering, simulation, scientific computing, financial models, biotech, protein folding, full cloud stack. This goes just deep into that as well. So again, you can take a picture going there if you want. In short, Coreweave is a purpose-built AI computing cloud optimized strictly for workloads that need massive GPU power, which essentially is most companies right now that aren't just like in the retail space, worth mentioning. Okay, going a little bit further, Coreweave, for their revenue and how they're making their money, Coreweave monetizes infrastructure through several channels, and this is the key difference, in my opinion, from something like Nebius. Okay, GPU rental, on demand compute, their primary model, the GPU hours, CPU hours, storage use, networking bandwidth. This is a usage based and can scale up and down quickly. Reserved instances and committed contracts. Again, the larger contract signed. This is the big deal where Nebius has really shined, signing companies like Microsoft and Meta. A few of the other bigger names are going, with Coreweave right now, but I think Nebius has the edge there. But again, larger clients, multi-month, multi-year commitments, dedicated user clusters, capacity reservations. These bring higher visibility that's still less locked in than the Nebius style. Again, this is why Nebius is better in this sense, because Nebius locks them in, that they are stuck with them based on their contract, right? But again, this is the bit more important side of the business, because if you're able to bring in high tier clients, big names, again, it's almost like marketing, free marketing, right? Not only are they paying you, but you're also, people are seeing that they're working with you, and it makes you more legitimate as well, which we went really deep into Nebius and what was happening there. But you can see Coreweave is doing a similar structure there. Dedicated AI user clusters. Coreweave builds entire GPU clusters for major customers who grant and want a guaranteed compute availability, including, again, the VX pipelines, high performance rendering, scientific research compute, biomedical simulations. A key point, Coreweave's revenue is more tied to short-term usage, data-driven demand, making it high growth, high volatility. Key right there. Sensitive to client scaling decisions, right? So you're kind of in the hand of these clients. Now, again, what you really want to see from a lot of these companies, specifically in this field, but I will also say just in general, something that I compare and look at these things to is something like Palantir, right? We've made a few videos on Palantir, but one of the staples that made Palantir such a great longer term company and really solidified them to where they got to, today, is they built their business on what was happening specifically with government contracts, and those were consistent, and they only got bigger and bigger and bigger, but they locked in these contracts, they serviced them, and again, they met it to a high level. And again, that was a great way for them to build out. If you're working with the United States government, why can't you work with a company like Microsoft? Why can't you work with a company like Google, right? So again, I'm not going to say that the United States is the best company to work with, but it definitely, if you're getting a reoccurring contract with them, it's a good thing to do. And so this is the concern with Coreweave for me. They're not focused on the long term, right? And again, it's a high volatility, high growth. So automatically looking at Coreweave, I'm going to tell you one thing. It's going to be riskier. I think these are both risky areas, but when you go into earnings on Coreweave, it appears to be more and more risk oriented, which we'll go more into that. But again, worth mentioning, we're still breaking down the company as a whole. The next part is their competitive positioning and value proposition. As you can see here, what are we looking at? Coreweave's differentiation comes from being a pure play AI cloud provider. Again, Coreweave claims faster provisioning, better GPU interconnect performance, high speed internal networking, lower latency across clusters, because they built their stack specifically for AI workloads. Okay. Unlike traditional clouds, Coreweave offers rapid scaling, faster cloud spin up, lower overhead, customer deployments, and a lot of these are the same things that Nebius is. Nebius, Coreweave, very similar structure type companies. Okay, this makes it extremely attractive for fast-growing AI startups. GPU access, Coreweave has become one of NVIDIA's largest partners in their private cloud space. This gives them early GPU allocations, ability to deploy next-gen hardware faster, competitive pricing power. Now, again, this is coming into that part of the build-out of data centers, and again, can they scale fast? Very important to understand that. Specialization, they focus solely on AI, ML, HPC workloads, visual computing. Important to know that also. Okay. Now, going into demand environment, who wants them? Is the demand going to be reoccurring, right? Is it going to be stable, which is what we want to see? And breaking that down in simple terms, if they're doing $200 million in last revenue, which I don't know their earnings right now, we'll go into that in a second, but if they're doing those type of numbers, are they going to be able to continue bringing that back to the table over and over and over? That's the real and the big question out there, right? So Coreweave is operating in a high supply constrained environment where the demand for AI compute far exceeds available capacity. This is something that we talked about with Nebius as well, right? Basically, Nebius couldn't, reach their revenue targets because they just didn't have enough compute. They didn't have enough data. They didn't have enough, right? Overall orders were ticked out because they couldn't just fulfill more demand. That was a big thing there. Its backlog, future contracted revenue, is very large. For example, backlog reached $55 billion at the end of Q3, up year over year. Once again, key deals are being announced. The company has signed $14 billion infrastructure deal with Meta Platforms to provide cloud compute capacity through 2031. Demand is broadening, not just hyperscalers, but AI natives and enterprises, cybersecurity, telco, government are ramping up usage. So this is the thing right now, is like everybody's rushing or everyone wants to use it. And this is the other part of it is, you're able to charge so much and keep the price up there because everyone's having the same issue. It's not just Nebius, it's not just Coreweave. Everyone's having the same issue. Everyone's has these mass orders into NVIDIA for more chips, Blackwells, etc. Right? So very important to understand what's happening there. Okay, the AI infrastructure bottleneck is real. GPUs, power, data center build-outs are all constrained. That means providers like Coreweave benefit this scarcity if they execute. Because of the large deals and locked-in capacity, many clients appear willing to commit ahead of need, indicating multi-year visibility, even though that's not what they focus on right now. The demand isn't just one model. Let me scoot that over a little bit for you guys, but spans in training, inference, new use cases, HPC, rendering, enterprise AI, expanding the addressable market. Demand risk, again, even though demand is strong right now, execution concerns, data center build delays, supply chain issues, hardware power shells are delaying the revenue can hit. So this is very important to understand. If they can't build out fast enough, which again is the other side of this as well, Nebius, it's going to be a lot of the same stuff, right? You're going to see that this will hurt them going into earnings, just like it hurt Nebius at this last earnings, as far as revenue is concerned. Because many contracts are long, there's a risk of bookings today, revenue later. Timing really matters. So just because you sign a deal doesn't necessarily mean you're going to get that money if you cannot fulfill that demand. If demand growth slows, or if competition plus pricing pressure accelerates, the margin utilization story can be punted, which is important to understand that. Let's say everyone builds out at the same time. So it's going to be a race, which is super important to understand. Let's say Nebius and Coreweave build out at the same time. They get done in the round at the same time. Coreweave is able to charge this a higher price. Nebius tries to come in and they kind of undercut to bring in more people, etc. I don't think that's going to happen, but worth mentioning if you start seeing a lot of openings at the same time. Coreweave risk summaries. I want to highlight the risk first before we go further. Okay. And I did the same thing for Nebius. Execution delays, data center construction. We talked all about this, power availability, which power availability is a real issue right now. And I actually do think power and energy is one of the biggest plays over the next 2 years. So more videos will be coming out about that. Or GPU delivery issues, delay revenue, and hurting the margins. GPU supply dependence relies heavily on NVIDIA, which we all know NVIDIA is already tied into $500 billion of open orders right now throughout the end of next year, which is insane. It relies heavily on NVIDIA. Shortages and prices changes can stall growth. It's worth mentioning if AMD and these other companies can step up, better products, maybe that steals some market share. Maybe that opens up the supply dependence and some of the build outs faster. But customers pretty much want all NVIDIA as of right now because that's like the cream of the crop, right? Cream always rises to the top. Customer concentration. A few big customers dominate usage, and any pullback could cause revenue volatility. Although the more you look at Meta's CapEx spend, Amex or Amazon and these other companies, it doesn't seem like that's going to slow down anytime soon, but it could happen at any point. I don't want to be the person to predict the future, but important to understand based off of earnings calls, everything that's happening right now. Okay. High cost and margin pressure. Rising power, hardware, and construction costs can crush profitability. This is something really interesting to think about. This goes back to like 2022, and this is a different type of market, but important to understand. As demand's rising for this and everyone's buying the same materials, you have to assume cost for said materials will rise as well. Go look at the price of lumber, for instance, in 2020 through like 2022. it was like sky high, which is one of the large reasons that prices for new homes rose, which no one really talked about, because the cost to build said homes went up in value, which again, no one really talks about. We all just say everything's a bubble and we don't really think and we don't use our brains, but it's important to understand what's actually going on out there. Now, I do think this is, interesting, and I will see the overall, caps and what they do with this, but I definitely think the United States is trying to put in a position where if you're building data centers here in the United States, if you're building out things in the United States, they want things to be in your favor and they want to help you out as much as possible. Worth mentioning. Heavy capex and financing risk requires continuous capital. Tighter markets could force dilution and slow expansion. I do think dilution will be a big issue. I would not be surprised if over the next few months, even with Nebius, that we see dilution in the form of offerings, etc. We'll see what happens, but very important to understand what's going to be happening there. Competitive pressure: AWS, Google, Azure, Nebius, and others could undercut pricing and secure more GPUs. We'll see. Again, I don't think that's the biggest issue right now. We could see that down the line, but right now we're so new to this. I think prices probably only tick up right now for the next year or so. I could be wrong, but worth mentioning. Slow backlog conversion. Big signed contracts don't convert to revenue, like we mentioned, until capacity is active, creating weak quarters. Regulatory energy constraints, AI regulation, data center permitting, or export controls could disrupt buildouts. Again, if this is heavily in the United States, which Coreweave is, again, I think they're in a fine position. I don't see a lot of crazy AI regulation. I see, again, Trump pushing the narrative of building out AI, et cetera, and using China competition as a big thing out there right now. Over-reliance on NVIDIA, we talked about there. One vendor dependency increases hardware and cycle pricing risk. Worth mentioning there. AI demand slowdown. If AI spending cools, Coreweave's usage-based model gets hit immediately, which, again, I think if AI demand slows down, we're gonna have bigger issues than just Coreweave, so worth mentioning, like most stocks will get hit. Now we're gonna go more in towards the comparison of the two. Now, again, if you want, you can go back over some of this. I recommend just watching the Nebius video to go back over this, but I really like Nebius. When we look at their numbers, how much money they've been making, I'm a really, really big fan. And we'll go more to the chart here in a second, but I think the chart also reflects kind of what I'm thinking and how I'm looking at this as well. So worth mentioning. We're going to come back to this part of the comparison because this is the comparison of Nebius and Coreweave, and go to the chart really quick. So number one, we'll start with Coreweave. And if you look at Coreweave, I think there's a lot of issues right now. So first of all, we talked about, breaking back below $100 would be brutal, coming back to 85, which you broke right below, and you really found no support. This is a daily chart, as you can see. So this is not like a small time frame, and you can see that you're continuing this decline as of right now. Now, for me personally, I would be willing to I would be willing to bet you're going to come down to this area here, right above my pretty little head, around $65, $64.5. That's your IPO high. So you IPO'd here, move this over, you IPO'd here, you shot up, you rejected, came back down, and once you mounted that, as you can see here, you broke a retest and shot up. That was your really big break on Coreweave. So the question now is, how long does it take to come down here? Then the question becomes, okay, if you break this level, well, what happens? Now, this is the really concerning part for me, is I think it's 100% a possibility that Coreweave could break below 65. If it does, you have to really start targeting these IPO lows, which no one wants to do. But again, that's really your only next level, which is all the way down at $38 to $40. Now, am I saying Coreweave is going to hit by 40, 50% right now? I'm not going to say that, but I just don't see the opportunity on Coreweave from a chart perspective and finding buyers, because again, you never really want to be the first person to buy a stock, in my personal opinion. For me, I like to find buyers getting back involved. So again, something that I typically look for. So in a bearish trend, short term, long term, whatever it may be, is you're making lower lows and lower highs. So painting a picture of what that looks like, really quick for you, is if your chart's up here, well, if you're turning bearish, you're doing this, right? You're lower high, lower low, lower high, lower low, and that's just kind of how this goes, right? That's a bearish overall structure. Now, when I want to try to find buyers, ideally, I want us to kind of bottom out at a certain level and then start making higher highs and higher lows to signify that we're breaking structure and getting back out of that, and buyers are actually showing a show of force. So again, that's just, in layman terms, is a very simple way. I'm not trying to catch knives. That doesn't really make any sense for me, and I'm not trying to get lucky, and that just doesn't make any sense. So what I'm looking at, how I'm looking at that specifically for myself, worth mentioning. Going into something like Nebius. As you look at Nebius, again, what we were really looking for is you wanted to see buyers hold this area right here around $90 to $87. And again, you just really couldn't do that. So what we were looking at is, number one, this big area of support right there, but then also going back to your previous all-time high right here on November 2021. around $87, $86. Well, again, you break below that. And as you can see here on the daily chart, again, it's pretty ugly. Again, it's worth mentioning the stock market didn't like really hold up that well and has been coming down. So again, I don't want to say it's just Nebius and Coreweave in the sector getting hit, but again, it's the market getting hit as a whole. And so what you need to understand is if tech is going down, if semiconductors are going down, then 9 out of 10 times, your stock's going to go down as well. But in this case, I will say this sector, the AI sector, the concern of the bubble is what is getting hit the hardest right now. So what you're looking at and why you're looking at it. So below that level, as you can see, you're rejecting. In my personal opinion, again, I think it's all but like guaranteed. We're aiming for that target down here in your $75, $76. And then you have your gap fill as well in your 68 and your 200 SMA. So those are 3 major levels I'd be watching. And again, as you're coming straight on a daily chart, not really finding buyers, I would be very cautious. Okay. But again, it's one of those areas right now. So am I buying either one of these right now? No. But as this chart looks, I actually like Nebius a lot more structurally and where you're at and some of these opportunities, especially if you get close to $60 to $58. I still like the $75 to $70 range as well, but I need to see buyers stepping back in, and I need to see like NASDAQ specifically in tech and semis to start bottoming as well. You might see those bottom first as the market as a whole, and then you might see buyers shift back into names like Nebius and Coreweave aggressively after that time period. So it could actually be a really good scenario if you're just being patient there for right now. So what I'd be watching, what I'd be tracking. Okay. So a really good visual understanding that. Hopefully that makes sense. If you have questions, let me know down below. So going back into the comparison, I think Nebius right now as a chart looks better structurally. Coreweave, it could really get into all-time lows. I think that's a real possibility, even though you're pretty high up still, but worth mentioning. Okay. So what they share in common, both are AI infrastructure players. They operate, or are building large-scale GPU data center infrastructures aimed at supporting training, inference of large AI models. Coreweave is described as providing a GPU-based cloud compute optimized for AI workloads, but again, very, very similar companies. Nebius likewise emphasizes vertically integrated AI infrastructure, large-scale GPU clusters for a wide range of AI innovators. Both are in very high-growth, high-risk mode, heavy CapEx, early profitability, or in many cases here, they're going to lose money overall right now going into the next few earnings. Strong dependence of supply of high-end GPUs, intense demand backdrop, right? Going into both are affected by similar macro industry dynamics, GPU shortages, data center build-out delays, power cooling costs, competition for AI compute capacity, and the risk of demand slowdown. So both of the headwinds for these companies, it's the same thing. Both have the same headwinds, both have the same concerns, okay? The only thing structurally differently is how they're setting up their contracts and how they're bringing in clients, right? One will let people come in, go out, go in, go out. Nebius on the other side, which that was Coreweave. Nebius is like, we're going to lock you down. You're going to, this is what you're going to do. If we have the demand, we have the right to fulfill that said demand based off of your contract, et cetera, which again, most of their clients have plenty of money as of right now. Going into more of a column breakdown of a few things. I think we have like 10 to 15, 12 or 11, sorry. So as you can see here, origin background, Coreweave, again, they both kind of come from the area of mining, which again, you guys know I hate crypto mining in general. I think it's one of the worst areas of the market, and it makes no sense to me to invest in it. Do what you want to do though. They both pivoted from that into AI data centers, etc. in the build outs. So worth mentioning, one's US based Coreweave, which that is the biggest thing in my opinion, is being US based. However, I will say Nebius is able to bring in a lot of money and have a better outlook of growth, not because they're not only just focused in the US, but not nationwide, but globally as well. Okay. Core business model, GPU rental usage, right? What's happening there? On the other side for Nebius, vertically integrated, owns hardware, data center, software layers, sells dedicated multi-year capacity, right? So again, pay as you go usage, longer deals. I like this one a lot more. On Nebius, makes more sense. Revenue style, usage-based contract revenue, more variable quarter to quarter. Can see really big quarters, could see them decline potentially. I don't see them declining like crazy. Wouldn't make any sense because demand's so high. Other side of Nebius, large multi-year commitment contracts, Microsoft Meta, higher revenue visibility based off the contracts that they signed. Now, the other part that I want to say here about this, again, if you build good relationships with really good companies, I think that has more value than just the dollar amounts that you're bringing in. I think it's very important to understand. I think Palantir is a great example. That's why Palantir now is servicing a lot of NATO countries, right? That's why Palantir is just killing it. So I think Palantir is just such a good example of why you want to harvest these relationships with really good companies. Okay. Now, granted, it's a business world. Things could go bad. You know, if they find a better opportunity, they'll leave you. But I still think it's very important. I think it goes a long ways. And I think Nebius is more focused on that. Customer concentration, very high, and handful of customers drive the majority of the revenue. Greater downside if one pulls back. Also depend on large hyperscalers, but balances this with multiple long-term contracts. Again, they're not just on Microsoft; they're also with Meta. Right now, again, there's kind of a few that there's not like a bunch of those names that they're partnered with. It's a small handful, but again, if one goes away, you still have a few of the other ones. Again, could be an issue. But again, as you see here, that's the real issue for Coreweave. And again, I'm not just trying to hate on Coreweave. I'm really not. I think they're both have potential, but if I had to pick out of the two, I think Nebius is looking better so far. Geographic footprint, strong presence in the U.S. and Europe. They're going more globally, like we mentioned before. U.S., EU, Middle East, and Middle East is a big area that I think has to be tapped in. There's a lot of money out there. A much larger geographic reach if you look at what's happening there and when I went to the Nebius breakdown. Okay. Demand narrative, essential AI cloud, flexible, scalable GPU hour rental, strong demand, but heavily tied to short-term supply cycles. On Nebius side, AI infrastructure landlord, contract secure long-term demand, claims to sell out every time new capacity is online. Again, we went into that. We love to see it. And I just don't, just looking at these two, this just makes more sense, right? More consistent. The only thing that maybe Coreweave could figure out is that they can just build out faster. It just doesn't seem like, it seems like they're both running into the same issue. But as of right now, Nebius, again, selling out every single time based on their earnings, based on their reports. That's what's going on there. Execution risk is higher in my personal opinion as well. Data center delays, partner build issues, GPU supply tightness, guidance cuts have happened. Still high as far as risk are concerned. Again, don't want to shy away from this. Nebius is still very risky, still high, but mitigated by some of their locked-in contracts. Risk comes with massive capex, and they have to deliver on those obligations, which again is still an issue. Financial profile, high growth, but margin pressure. Guidance cuts due to construction delays. Massive capex, a lot of spend, revenue buildup, revenue up to triple digits, but still significant losses as they scale. Again, there's no question about this. These are hyper-growth companies. Their numbers are going to almost 30% to double over the next few quarters and quarters and quarters. You could see very large jumps. We'll go back into those earnings in a second. But again, they're spending a lot of money. So I'm not expecting these companies to turn a profit in the next year. But as that continues, you do suspect the profit to turn in going in towards 2027. In a perfect world, right? Again, worth mentioning. Valuation, more pure play AI cloud, volatile, sentiment driven, big pops, drops on execution, more infrastructure as a service, focuses on long-term AR, annual revenue, visibility, still speculative, but slightly more structured, as we've seen there as well. From a trading angle, high volatility setups, unusual options flow, contract announcements. So when those contracts, big deals come in the short term, they're gonna have a lot more of those a lot more frequently. So you might get the occasional pop more often, right? Longer duration, growth narrative, CapEx, ramp spinning. They need to be building out hyperscaler partnership catalysts like Meta, Microsoft, etc. They're going to get fewer of those, but when they come in, again, very bullish for the company. So that's really the more fundamental breakdown there. Again, going back to the chart as we look this, again, I just think Nebius is better, personally. I think they both have downside in the short term? Yes. But I really, really, really like where Nebius is at personally. That is just my personal opinion, kind of how I'm leaning out here and what I've been looking at. I know a lot of you guys want me to cover Coreweave, but the reason why I didn't cover them in the first place is because I just didn't like them as much. I knew I liked Nebius more, but I decided to do a breakdown here, break it down for you guys, answer any questions. Could I be wrong? Could Coreweave come out on top? Could they start making more money? Maybe. I could be. But again, as I'm looking at this right now, I think Nebius has more profit potential as far as me investing into it. And I think it just makes more sense for me. If you have any questions, let me know. But before I let you out here, we'll look at some of the revenue as well. Since IPO on Coreweave, you did $981 million around, what was that, the first quarter of the year. Second quarter of the year, they didn't even show off the revenue. I don't know what the hell's going on there. I'll go into that in a second. And then 1.36 billion. I need to go Google that. I can bring it up in a second if I need to. And then going into Nebius, more recently, the same time span, again, they did 53 million, which they weren't doing as much money, as you can see, but then they doubled into 105 million. And then again, you go into this area of 150 million, basically there. The growth is very, very dramatic, as you can see. That's why I really like what Nebius is doing. And again, these numbers, like I said, we went into the contracts they have. This could get into the 1 billion range quickly, in my opinion, going into this next year. So Nebius is making less money at this point in time as far as gross revenue is concerned. But again, both of these companies are unprofitable for the time being, worth mentioning there as well. So again, what I'd be looking at and what's going on there. Now going more into market cap so you can see structure. Coreweave market cap is sitting at around 38 billion. Go into something like Nebius at highs. Obviously Coreweave was much higher. Nebius's market cap is sitting around 21 billion. So I still think Nebius is, like I've said, I've been very clear. I think Nebius is still overvalued. I think Coreweave is overvalued. From a earnings standpoint, I think that Coreweave is less overvalued than Nebius for sure. But again, where my mindset is at as far as growth the company is providing and where it's at right now is kind of where my head at. What I'm thinking, if you have any questions, please let me know down below. Again, as of this right now, I think Nebius is the play that I like more of a gut play going into the financials, what we're looking at there. I think they're going to also ramp up very quickly their earnings as well. So I'm a big fan there. Have a good one. Let me know your thoughts down below. See you in the next video.